Hey, welcome back to the channel, Fully Invested Phi Labs. Today I wanted to go over my retirement accounts and my wider portfolio and why I've not been contributing to my work 401k for the last 2 years. Up until now on my YouTube channel, across my main channel, and now the companion channel, I've mostly been focused on my taxable brokerage account and how I'll be using that to retire early. But I kind of wanted to break down the wider strategy of how I'm going to use a two-pronged strategy of how I'll both be using my taxable brokerage and my retirement accounts to retire early. So there's going to be a little bit of leapfrogging between the two. So as a note, this is also the kind of content I'll be doing on this companion channel after the end of January 2026, where I'll mostly be covering my retirement accounts and any moves there, and also covering my mom's retirement accounts, which I'll be doing a video on soon. So yeah, look forward to that kind of content. It'll basically be anything that's outside of the taxable brokerage. So yeah, before we get started, of course, the usual disclaimer, this video is for entertainment and educational purposes only. I'm not a financial advisor and nothing here should be taken as financial, investment, or tax advice. I'm simply sharing my personal investing journey and documenting my own results. Investing always carries risk, especially when using margin, and you can lose money or your principal. So don't copy what I'm investing in blindly without understanding the risks and researching things on your own and doing your due diligence. No returns are guaranteed. So yeah, if we pop over to this flow chart here, as a refresher for people that are new to the channel, you can see this flow chart of how I invest 100% of my paychecks every month in both growth and high yield income ETFs and live out of my brokerage account. That means the minimum I invest 10.8K every month in the portfolio and that I pay bills out of my Robinhood brokerage account. I don't use a traditional bank account anymore. I fully live out of my Robinhood brokerage account. So if you want an in-depth breakdown of this, you can watch a video here at the top right, and let's get started. So if we pop over to Robinhood here, so this is the main portfolio, but today we'll be going over the retirement section. So we'll go over here. So I have two different retirement accounts here. I have my traditional IRA or rollover IRA. I basically, across like the last few jobs that I've had, I've basically rolled over all my 401ks into this account. So this is what I've kind of accumulated ever since 2017, really. And then also I have my Roth IRA over here. So between these two accounts, I have roughly 156K. The reason I've actually not been contributing to my 401k or my rollover IRA here is quite simply, I work at a startup currently and they don't offer a 401k match yet. So personally, I didn't feel like it's worth contributing to that until they have a match. So once they do offer a match, I'll start recontributing to my 401k. So like in my previous job or something, like we had a thing where like you'd contribute 6% and you'd get also like a 100% match of that, right? So yeah, I'm not getting anything of that right now. So and the big reason I'm doing that is like, one, I really want to push into my taxable brokerage as much as possible and really kind of get that income engine going that I've been doing for the last half a year, basically. But also like once I ran the numbers for my current 401k that's been rolled over, so basically this 133k, right? Yeah, once I ran the numbers, I felt comfortable doing that, honestly, because like, yeah, once I ran the numbers, like that 133k, if compounded over the next 25 years, like assuming I start taking it out at 59 and a half or 60 years old, yeah, that portfolio would reach anywhere between 1 and 2 million on its own. So with no new contributions at all. So I can kind of go over that as well. So, but first let's just quickly look at this performance here. So this portfolio is like pretty simple. You can kind of see that there's like quite a bit of money in SCHD and then VGT, right? So there's $103,000 in SCHD and then 29.9K in VGT. So yeah, as you can see, it's like pretty conservative as far as my portfolio goes, like especially compared to my taxable brokerage. Yeah, SCHD obviously hasn't done the best this year, given that like it's very tech heavy this year as far as performance goes. So when tech is heavy and going hard, like SCHD typically lags, given that it's more invested into value funds. So it's a lot more conservative, but I do have a VGT exposure here too. And then also what's happening here is that like SCHD's dividends, so I get quite a bit of dividends from SCHD. So if I pop over to my thing over here, so yeah, this is my section here for my 401k. Yeah, I've gotten over like $13,000 in dividends from SCHD since I invested in 2022. So I started with 80K here, as you can kind of see. So yeah, what I did for a while, I did just drip SCHD onto itself. And so I got a lot more shares, and then that's kind of just growing the annual income here. So roughly I'm getting $328 a month from this. And yeah, but recently what I started doing is actually taking the dividends and actually investing in VGT. Yeah, I'm still kind of debating whether I still keep SCHD. I do like that it's like relatively conservative, but maybe it's too conservative. We'll see. I'm still debating that. But like, as you can see, what's been nice though is like kind of seeing how, yeah, despite the market volatility that's happened since I brought this over from Fidelity, it's just been steadily going up. So yeah, it doesn't dip as much as like the main portfolio, obviously. honestly, but it's kind of kept up a steady 8% over the year. So like even if I can compare it to the normal portfolio, so year to date, yeah, given the margin and how it's got dragged down by dips and stuff like that, this is the main portfolio is actually down lower compared to that one. But this one, yeah, just doesn't dip as much because of SCHD, which is nice. So just kind of steadily growing, not as much as if it was like fully in VGT, right? But it would drop a lot more. So yeah, still debating whether I kind of change up from SCHD, but so far I've been liking it, and I've been liking the dividends going into VGT instead. So to get back to the topic here, got a little bit sidetracked there. I calculated projections for this. So I'll just go on the site here instead of doing a spreadsheet today. So yeah, I like using Market Beat's dividend calculator, and this is actually what I used initially when I kind of decided to like not contribute to the 401k and to kind of confirm that decision. So I have to get a couple different numbers here. So if we pop over to, actually, I'm going to split these tabs together. New function that I discovered in Chrome lately, which is great. All right, so I'm going to need a couple of numbers here from my spreadsheet here. So starting principal, so we'll go off of that. So let's do the 133,296 initial annual dividend yield. So I have a cumulative yield here that I've done. So yeah, here's the yield on cost. So that's 296. Yeah, and you kind of see that my dividend yield has gone up quite a bit nicely compared to base SCHD because I've been doing this since 2022 and just reinvesting dividends. So it's gone up nicely. Annual contribution, I'm going to assume 0 right now. Expected dividend growth. So this is over here. So 5.03%. So that's what's great about SCHD, right? The dividend growth that happens every year, 9.15%. No taxes because it's the dividend. And then CAGR for share appreciation, that'll be, this is weighted, right, based on the allocation. So SCHD, the last 10 years has averaged 11.53%, which is great. Roughly matches VU, a little bit less given VU's uptick with tech stuff recently, and VGT's at 22.57. But like, yeah, weighted based on its allocation, this is what it is. So 8.95%. Years invested, so I'm assuming from 35 now to like 60, so 25 years. And we can calculate that. So, and also like to note how I got all these numbers. So for the average 10-year CAGR, I like using this one site here. Yeah, this stock return total calculator. There's a stock one and an ETF one. And I'll link them in the description below as well too. So what's nice here is that, say for the ETF one, I'll just do VGT and then calculate return. Then you'll kind of get your CAGR over the last 10 years here. So that's what I typically do. I did that for both VGT and SCHD. And yeah, and then you can kind of get those numbers there. And that's what I input there. And as far as the dividend growth rate, I kind of typically just get that from Seeking Alpha. So you can kind of just go on the dividends for SCHD, for example, and you can kind of get the 5-year growth rate here. So I did that for the SCHD and then VGT as well. Yeah, that's the basics of that. So let's just check the calculator here now. So yeah, so if assuming all these numbers, yeah, my ending balance by the time I'm 60 would roughly be 1.224 million or 2.49 million. So yeah, you can kind of see how that might go, really. So you can kind of see that so that's a pretty good number overall. I could like I said, like if I potentially tweak the portfolio and maybe get out of SCHD just to kind of have like better compounding over the long run, I could potentially do VU and maybe do more of a 50-50 split between VU and VGT, or maybe 75-25. And then I could probably juice this even more potentially. Still a decent amount. And then what I would do with this potentially is then generate income from it, right? So yeah, that's what made me comfortable to like, okay, if I'm not contributing to my 401k for the next couple of years, it's fine. Like eventually I will start recontributing to it, but knowing that if I didn't, I would get to this number in 20 years. Still pretty good. Yeah, so that's for the 401k. Yeah, that's where we would be. And as far as the Roth IRA, we could probably do the same exercise here, but if we go over to the Roth IRA here. So again, here it's pretty simple, just 3 positions. So VGT, BTCI, and MS Microsoft. So if we switch over to like Alder equity here, so I have like 10.2k in VGT, 9.2k in BTCI, and 4.3k in Microsoft. So yeah, if we pop over to my Roth IRA over here, you can kind of see them. Microsoft has done amazing. It's like up nearly double what I put in. BTCI is down a lot because I switched this over like right before it started dropping, and VG is doing great as well. Yeah, this portfolio, as far as kind of tweaking it, like I go back and forth. Like some days I just want to just get rid of Microsoft and just lock in all those gains and then just throw it into VGT and not have to worry about any single stock risk. BTCI as well too. Like yeah, I just don't I haven't invested for a little bit for the last couple of years into like pure Bitcoin plays, and I always kind of like getting a little bit of income of it given its volatility. But yeah, I know some days here I'm thinking like, oh, maybe I just switch this BTCI, at least for my Roth IRA, into just like a pure Bitcoin ETP like FBTC or IBIT or whatnot. But now this is good, and I'm like actually just today, because as I was revisiting this, I just realized like I'll be taking the dividends of this, and instead of reinvesting it into BTCI, what I might just do is actually maybe start investing it in Bitcoin purely in here. So it can kind of have a bit of both, extract some income from it, but also get the pure growth from it too. So yeah, so if we run the same numbers for this Roth IRA, so we can kind of do that, and actually I'll do a separate one here just so we can have both still. Let's see here. So what the portfolio total is 23,867 annual yield. So yeah, current yield. So BTCI is really throwing it off. So what I might do here is actually just combine these two instead, just because it's gonna throw off the calculations like crazy if I do it 12.6% yield. So yeah, I'll just do 0.75, 0.40 instead. So that's 115 and 0 annual contribution, expected growth. So the CAGR on these are quite a bit bigger. So this is actually 22.81 given how high these are over the last 10 years. BTCI is a little bit more recent, but yeah, 22.81. And then dividend increase would be 3.35, let's say. Okay. It'll be invested for 25 years and no tax rate here again. So, oh, I forgot to do quarterly for this. But yeah, this one, given how much higher the CAGR is, like you can kind of see how this might potentially grow even more. So you can kind of see why like potentially it might be good even in this portfolio to maybe rebalance things between SCHD and VGT, just so I could get even more growth compounding over the next 25 years. So yeah, between my 401k here, that would be potentially at 1.248 million. So let's just calculate that out. 1.428 plus 4.304 million. So potentially 5.5 million, which is just crazy to look at as a number. And this is assuming I don't contribute at all for these, right? That's what's even crazier. So I'm assuming that I'm not contributing to these anymore. But it is worth noting that I do still contribute to my Roth IRA. So I am above the income thresholds, obviously, for the Roth IRA. So I forget what the income thresholds is right now, like 130K or something like that. But I'm way above that. So what I do to contribute to my Roth IRA is use the backdoor Roth IRA, which is nice. And yeah, personally, I really love the flexibility of the Roth IRA, as it can, one, it's tax-free growth through the lifetime of the account since you're using after-tax dollars. And also what's nice is that it does kind of double a little bit as an emergency fund as a last resort, because you can pull out your contributions at any time with no penalties before 59.5, so long as you don't take out any gains. So for example, like say I contributed 14K in 2 years, right? So let's say I did 14K over 2 years, right? Beautiful. And then that grows to 20K. So like 6K in gains, right? You could always take out this initial 14K that you put in. So, and that's tax-free, that's penalty-free. So the only caveat there is that you can't re-add this 40K after, right? Basically the 2 years that you contributed are gone. So you can't replenish it. So that's just the downside there that you need to kind of keep in mind. But yeah, it's useful, and that's why like another reason that I forgot to mention the other day for the emergency fund stuff is why I'm comfortable not having any, because yeah, I have stuff like my Roth IRA in the background as well too, potentially, that I can pull from. So yeah, so when we look at my retirement stuff here, I think there's at this point maybe 2-3 years worth of contributions here that I could potentially take out, maybe actually even 2 years, because I just have a lot of gains as well too. So I think yeah, there's like 14K of this I could pull out tomorrow if I wanted to. So yeah, and I've actually done this in the past and a couple of years ago. In hindsight, I wish I didn't, but I did it for when I needed to do some like house renovations. I basically pulled 14K from this at the time, and yeah, that was tax free. That was great, and yeah, that's a nice feature of the Roth IRA, right? But yeah, I didn't have my HELOC at the time, so that's why I didn't do it. But yeah, and you can kind of see here too, like if we compare like both these accounts like year to date, right? If I pop over to my traditional IRA here, so you can kind of see how these are performed, like as far as like this one being more volatile, like because of my BTCI exposure, this has gone down like quite a bit, and also VGT being higher as well too in here. So you can kind of see how this has gone down a lot and hasn't quite recovered yet. So yeah, there's pros and cons really to both strategies, right? So this one's a lot less volatile and will kind of maintain its value better because of SCHD as the anchor. So yeah, I still need to think on that, whether I rebalance that, but as you can kind of see from this too, like you can kind of see the difference here as far as like the CAGR, like how crazy that can be. So I don't know if like it's worth paying that more than 3 million difference just to have a little bit less volatility on the short term, right? Like gotta think long term. So still gotta think on that and how I potentially rebalance this in the future. But yeah, so that's where my 401k is and my Roth IRA is, right? So you can kind of see where things land. And so how this feeds into like a two-prong approach that I've been mentioning. So if we pop over back to the brokerage right now, now, this brokerage account, so that's sitting at 150,000, 940,000. That's generating roughly $5,043 a month, right? And yeah, I actually just recalculated all these this week too. I started doing for my dividend calculations here. So I started doing the trailing months dividends essentially, so 4 weeks. And I think that's been a little bit closer to what I've been getting, more so than the median of like the year to date. So I think I'll be doing that going forward, just see how that feels. Yeah, because this seems like a little more down to earth and like maybe a little bit closer to what Snowball's doing, but with a little bit more history of like 4 weeks rather than just the last payout. So yeah, so 5,000 a month. So really the goal is I have like a two-prong approach. My taxable is basically going to feed my early retirement from 40 to 60 years old. That's the goal, right? So I need to basically fill the gap of 20 years. And then once I hit 60 years old, right? And that's retirement, like normal retirement, had I not been trying to pursue this early retirement with my taxable, that's when all my Roth IRA and 401k kicks in, right? So my 401k kicks in, I can start drafting from it, and same for the Roth IRA. So yeah, once these are, so what was it? It was like 1.2 mil potentially, and then 4.3 million potentially. So yeah, together that's 5.5 million potentially. And yeah, and then that's where I'll probably start generating income from this, right? So here I might maybe sell and then maybe put it into kind of like a safer yielding, like 10% yield income instrument potentially. Or if potentially my taxable is also still working great and still generating income potentially, like assuming high yield income ETFs are here to stay, that could be a thing too, where I kind of just let this keep growing, or I liquidate it for different things. So there's different ways that depending on how things go from between now and then that I could do. So yeah, that's really the two-prong approach. So like, yeah, my taxable will basically bridge the years. I'm basically like hoping to have that bridge the 20-year gap between 40 and 60. And then from there, the retirement accounts can kind of take the lead and kind of be providing that income, assuming, yeah, let's say this income doesn't pan out, right? Too. And also one thing that I'm not factoring necessarily into is Social Security. Yeah, I don't know if you know, but on the Social Security website, you can kind of get your rough number of what you'd be getting monthly. So potentially, depending on when I start taking my Social Security payments, like if I take it at 62, it'd be like 2.9K a month. If I take it at 67, it'd be 4.1K a month. Or if I take the last one at 70, that'd be 5.1K a month. So that still remains to be seen how well the government will manage to fund Social Security. But honestly, I've been operating as if there'll be no Social Security. So yeah, I'm just relying on all my accounts, and any money that I get from this is just bonus money, right? Like call that play money or whatnot. So yeah, I want to rely on myself to hit retirement. I don't want to rely on the government for that. That's really the two-prong approach, right? So step one is the taxable brokerage that should bridge the gap between 40 and 60 years old if everything works out. That like all the stuff that you see that I'm doing on my normal videos, that's feeding into this. And then two, retirement takes the leg at 60 years old. And also, yeah, then that money will start kind of either be yielding money that I need. Yeah, whatever else. We'll see how the taxable stuff works out. If it's still paying a yield by then and I don't have to liquidate this, that's great. But yeah, maybe I do just a bunch of other stuff with that. But this account as the backbone and the anchor in the background definitely kind of gives me a lot of comfort, even though I'm not like fully contributing to it right now. But yeah, that's the retirement plan there. So I know some people have asked at the time, like, oh, where's your retirement accounts? And so there it is, right? So that's why I'm allowing myself to be a bit more riskier with my individual account, because I have this in the background and I know that's there. So yeah, that's my two-prong retirement plan really. And as far as where the retirement accounts sit within the larger portfolio, we can kind of look at it here. Yeah, so total, I have $159,034 in the retirement accounts. I have $35,623 of gains, and I have a total return of 28.87%. In the larger portfolio, you can kind of see how it sits here against the other ones, right? So I have my Roth IRA here and my 401k. There's also the HSA, which I honestly is just kind of like play money, and that's what it kind of messes on with options or just like YOLO plays and stuff like that. I'll probably get into that in another video. But yeah, the Roth IRA and the 401k are the main ones here. So those make up for a good chunk of the portfolio. Yeah, just cresting over $500,000 between my taxable brokerage account, and the equity in my house, and yeah, the Roth IRA, HSA, and 401k here. So yeah, that's where it sits within the larger accounts and how everything divvies up. If you have any questions, comments, definitely post in the comments here, and then we can hash it out there. But yeah, as usual, if you want to follow me off YouTube, there's a bunch of different ways you can do that. There's of course, yeah, so there's Blossom Social over here. Yeah, I post all my videos on here as well, and you'll see any of my trades as well as too as they happen. Links for this and all the other links that I'm going to talk about now are in the description below. You can all follow those along for free. There's of course my Snowball analytics portfolio. This is all free as well. You kind of see like a just transparent breakdown of everything, like all my pies of like how I split stuff between my anchor ETFs and my single stocks, my high yield, all my total profits. Like, yeah, I love being transparent with all this. So you can kind of see all my numbers, right? You can see the yield on cost of all the dividends I've received. So yeah, tons of data to dig into there and to look at. And then also just all my trades as well too. Like all my transactions are in here too. So, and then also there's Patreon that you can kind of see. This is really just a backup in case there's more YouTube shenanigans. I basically upload day and date all my new YouTube videos, and all my backlog is on here too. So this is just a way to kind of keep something off platform just as a backup. And yeah, and then of course there's our Discord channel. Yeah, over 200 members strong, 212. So growing great. Lots of great conversation here. Like always good stuff from Brent, who's talking about how the market's doing in a particular week. Saw that Mr. Beast is start launching a finance and investing channel soon, which is crazy. So the space is going to get interesting once that happens with how big he is. But yeah, tons of great stuff there. I like to share YouTube videos that I've been finding during the week, and sometimes you get a leg up of like what my finance video of the week might be. And all my trade alerts are here, of course, as well too. So lots of ways you can come follow my trades and see what I'm doing and connect with other like-minded investors. So yeah, if you like this video and if you're looking forward to more retirement account content, whether mine or my mom's account, you could follow me on Fully Invested Fi Labs for after January. But you can also follow me on the main channel, Fully Invested Fi, which I'll be back to at the end of January. So yeah, just give a like and subscribe, and I'll catch you in the next one. Peace.